Yo, what is going on? It is Maleki, the Growth and Dividend Growth Investor. Welcome back to the channel. Today we're going to be going over the monthly portfolio update. So overall, total amount of money in my three different accounts is $161,545.81. I'm implementing three different strategies in this account. I have a index style investing, which is my 401k. I have a dividend growth strategy, which is my Roth IRA. Then I have a growth strategy in my just typical brokerage account. So basically I have these three accounts broken down into like tax advantage versus non-tax advantage, and then as well as the style of investing. So if you look at my graph over here, it seems that the growth holdings have been exploding recently. I do own Tesla, and Tesla's been having a crazy run up. And then my 401k investing, my dividend investing is a lot smaller. So like the growth holdings is just kind of eating up the rest of the pie. And that's just because like Tesla's been having a huge run this year. And it's just really interesting to see if it's going to sustain this run, or is it going to level out for a little bit of time. Also in my kind of graph, my things over here, I kind of cleaned it up a little bit and color coded it so it looks a little bit prettier. So I hope you guys appreciate that. And then just kind of like going over like these two additions over here that I added. So I added two extra portions. One is my monthly net worth, as well as I'm actually going to start like a Robinhood account with $16,000. And actually I took the $16,000 from this. So realistically, my total amount of money I have invested is $177,000. But I don't want to add this like play money over here in my Robinhood account, because what I want to do is I want to sell covered calls, and I want to see if I can maybe take this $16,000 to maybe 100 grand by next year. We'll see. But I didn't want to add it onto this portion. So if you see here in my like YouTube, I've only actually added all three of these together since September. So like if you look at my previous videos, I've only had like $40,000 or $50,000 in there. That's just because I wasn't adding my 401k. Now since like I do updates on with the 401k, it's since then, it was since September. So ever since September, I've had all three accounts added together. So this month is December, and it's been a nice increase almost month over month, and that is attributed solely to Tesla going up, but then also to like even in the other accounts in my Roth and my 401k, the market has been recovering pretty nicely. So I just want to show you guys that like my style of investing, I'm the type of guy where I don't really like to compromise on having to just only pick one style. I am basically implementing the three styles that most people invest in, which is like growth investing, dividend growth investing, and like index investing. And what's going to be interesting though is I'm actually going to show you my fiance's like portfolio, and you'll see there's a stark difference between my portfolio and my fiance's portfolio. In my portfolio, like I have like a higher risk tolerance, so I'm actually picking more individual shares. So I'm actually in my brokerage account, I actually have Tesla, which is one holding, which is a huge risk if you're not diversifying, but I have a huge belief that Tesla will be going up in the future. And then even in my Roth IRA, I have actually 34 individual holdings. One is an income play, the other 33 are actual stock holdings. So instead of picking ETFs or index investing, like I'm actually investing in individual stocks, which is riskier than index investing. And then finally, like we both have 401ks, so like we both are index investing, but you'll see that in my account, I actually invest in individual stocks, where she invests in more ETFs. And that's kind of how I want to set it up. So just kind of going over to my fiance's portfolio over here. You know, we both have the same 401k. We work at the same hospital. So, you know, there's nothing special here. So both of us are index investing in our 401k. We're not picking individual stocks or anything like that. And then for the Roth IRA, I'll tell you one thing. She is not a stock market enthusiast like I am. So she the approach that I wanted to take when building her Roth IRA was like a set it and forget it. So what I wanted to do is like I wanted to focus on income in the Roth IRA, whereas like in the brokerage account, which is like a taxable account, I wanted to focus more on growth, because you get taxed on the dividend distributions, and I don't want to be getting taxed on all these distributions if I had like a VYM or VYMI in this account. So in the Roth IRA, these are more like higher income paying ETFs. So VYM is a US high yield Vanguard account, and then VYMI is the international. And then I have 80% of my 80% of her well, it's our holdings, it's our money, but 40% of her holdings are in VYM, and then 40% in VYMI, and then 10% here, and then 10% in this one, so which makes up 100%. So she's only been investing in this account for about a year. I made her open a Roth, and she actually really likes owning one. And the final thing we have here is just like a typical brokerage account. So the three things I wanted to have here was, and I think I put this in another video, if like you were going to pick two things to retire on, is just VTI and VXs. That's all you really need. But I want to add in the triple Q because it does have a higher return. So I just wanted to have more tech exposure into these three things. So I do believe in the future that the international markets are going to maybe even surpass the US markets. So I wanted to almost equally weight all three of these holdings in her account. I mean, she doesn't have too much money here, but that's just kind of the approach that I wanted to take when putting this together. And then kind of same thing as in the other one, as in my side, I just want to show her monthly net worth. I have started investing like 2 years before she has. So I just wanted to compare how much money she's making like month or how much it's increasing month over month. So just kind of like interesting just to compare and contrast like one style, which is individual stocks, and the others, which is more like ETF based investing. In the Roth IRA, kind of going more to the comparisons, it's interesting to see because again, these are all ETFs, where in mine is actual individual holdings that are broken down. So it's going to be really interesting to see what the actual dividend yield. This dividend yield is not represented or is not representational of what her actual yield of these are. And the reason being is like prior to updating her Roth IRA, I made like a late change. So basically, I think her Roth IRA was composed of these holdings, which don't necessarily pay a really good dividend. And you can see that she's only had a very, very minimal payout because if you have the triple Q, it barely pays anything. And then VTI is like 1.8%, and then VX is actually a little bit higher, but then the dividends didn't have enough time to like fruition, to build off of. So, I mean, this isn't the actual dividend yield of what this is, but we'll see what 2021 has in store for the actual dividend yield of like this type of portfolio. So I'm actually curious to see how this portfolio does compared to the individual stocks in this one. So, some of these are much more riskier because it is individual stocks, but we will see. And then just wanted to show that Vanguard 2060 retirement fund. I mean, for the most part, this is like your typical like index investing. Like if you do this, you put your money away for 30, 40 years, like you're going to retire with a good amount of money. So when I started investing in this, I believe I started investing in it in 2018 when I actually started working at 2016 as a registered nurse. And then they didn't let me put money in until 2018 because I needed to be an employee there for 2 years before I could start putting money away into like the stock or the compensation plan. So I only really started putting money away in 2018, and it's just interesting that for the most part, this is just following the broad market. So, nothing too special here. So yeah, just want to show you guys that, this is like the 401k that both me and my fiance are kind of investing into. It's the Vanguard Target Retirement 2060 fund. So just want to show you kind of like the comparison, see just like how like the two are working. Let's go into the M1 finance portfolio. So for the most part, this is my growth account. I do try consistently investing in this account. There's so many different ways to invest, and I'm basically choosing three different ways. I'm choosing index investing, dividend investing, and growth investing. And the most important thing is not the style investing, but the principles behind that investing. When you're investing, you really want to have a solid game plan. And the game plan is to be putting money in over time. The stock market's going to go up, the stock market's going to go down, but if you have quality holdings, whether it's ETF or individual stocks, it will go up over time. And as time is going on, you want to keep cost averaging that money. Like dollar cost averaging is like the eighth wonder of the world. It allows people to build wealth. So it's a beautiful thing. I just want to talk about kind of what went on the last couple of weeks. So basically what happened is because I decided to venture out into the world of covered calls, which I haven't even started yet. So I'm waiting for my money to transition over into a Robinhood account, and it's been taking a couple of days now. So I'm trying to be patient with it, but I just kind of want to dabble my toes in investing in covered calls. And then It's not something I'm going to necessarily talk about too much. I just want to like dabble in it. I'm not going to make any really crazy risky plays. I'm very risk averse, so I'm trying not to lose the 16,000 I use. But basically what happened was I used to have a 50-50 split between Tesla and ARK, and what happened was I sold out of the ARK position and I bought 61 shares of Tesla. So currently right now I used to own 99 shares of Tesla. Well, now I have 160. So I used to own like 440 shares of ARK. Now I have 160 shares over here. So it's just really, I feel that Tesla is going to have more explosive growth going forward. And ideally, if this covered call strategy that I'm going to implement, if it's going to work with some of these other stocks, what I would like to do is transition Tesla over into a different brokerage and actually sell covered calls in this. So ideally, once I get 200 shares, the premiums that are paid, even in like a safe range, would be pretty substantial. So I could almost end up making like $400 to $1,000 a week if I had 200 shares of Tesla. But again, that's not something I really want to talk about. I just want to talk about like building wealth over time in a non-risky way, just the strategy you implement. So basically, I don't know how I preach this all the time. By the way, whoever used my referral bonus, you are a gangster. Thank you for the $10. And I hope you enjoy your $10 too. So basically the main idea is, it's about putting that money in. Okay. There's actually two people. No way. This is nuts. All right. Well, you two people are beasts. So basically the key is to be putting away that $125 every week. I choose $125 a week is an arbitrary number. I want to be investing $500 a month to build wealth. So every single Monday morning, I put in $125 in the market. And in doing so, it allows me to capture all the highs and lows. So if you look at the month, it goes up, it starts coming back down, goes up, goes down. And for the most part, like you're capturing all of these different ebbs and flows. You buy here, you're buying here, and it allows you to kind of cost average. So then it ends up being that your average cost will be in the middle. And then eventually when it keeps going up, you're going to be making a nice chunk of money. So, the strategy is the same, just, putting money in over time and dollar cost averaging. Just like I said, it was like the eighth wonder of the world, and that's what you want to be doing. And then, if I had like any extra chances, I put in some extra money. And then here, I sold like that ARK position, which was over $51,000 worth. I took 16,000 out, and then I put the rest, the other $38,000 into Tesla. So right now, the only holding I have is Tesla. So we'll see how it goes. Couple catalysts going for Tesla right now is the S&P 500 inclusion. December 18th, or I believe December 21st, the S&P indexes will be buying up all of these Tesla shares, which will be one of the largest companies ever put into the S&P 500. So I believe that'll be like a really good catalyst. I believe after this inclusion, I do believe that Tesla will downtrend for a little bit of time. I'm sure the production numbers are going to keep increasing, which is exactly what I want it to be. But I think for some time we'll be trading sideways, which will allow me to, keep buying shares at a pretty reasonable price until they hit another one of their like huge catalysts, which will be like solving autonomous driving, their energy sector really ramping up, semi-truck production. So like, Tesla's got a lot of things down the pipeline, new factories going online in Germany and Texas. So, there's a couple things that they're ramping up that, I continually still want to hold Tesla. I believe it's, even for the price it's at right now, it's completely undervalued. But that's besides the point. The most important thing is whatever strategy you decide to do, you do it well, and you dollar cost average. Those are the most important things. And again, we're just trying to keep soaking up all these shares, so then over time we can possibly retire early, or we can retire very, very comfortably. Whatever you decide to do. Like if you want to retire early and be like a minimalist and like live off like $2 a day, go for it. But like that's not the thing that I'm trying to do. I would like to retire early, but when I retire early, I want to have stacks of cash. All right, so that's my growth account. Let's go over to the dividend growth account. In the dividend growth account, $14,835. I've been changing this thing like crazy. I think you guys know that I've been changing like crazy. Let's look at the details going on, what I'm selling. Or I'm going to be buying Honeywell and Waste Management. I'm actually going to be getting rid of Old Dominion Freight Line. And when I get over to that section, I will discuss why, my thought process behind it. So let's just go over to the portfolio, and just real quick, I just wanted to show the overall dividend yield. So again, 34 holdings, 4.11%, expense ratio 0.14. When I go over to my dividend tracker, my actual dividend yield doesn't line up with it, and I'll explain why it doesn't, but we won't do that right now. So just kind of going through the different holdings. What I did in the real estate sector, I actually added Crown Castle and American Tower back into the real estate sector because I didn't want to have any communications, and I was thinking long and hard what I wanted to do. And I want to have my holdings line up in the section it's supposed to be in. So like, I didn't want to have Visa and information, or I didn't want to have Visa and financials, and I didn't want to have Crown Castle, American Tower, and communications, even though they are real estate trust. Ideally, I like to only have upwards like 4 to 5 holdings in one sector, but I just couldn't resist having Crown Castle and American Tower in here, because even though they are cell phone tower REITs, they do have different styles of gaining market share. So, these are all my holdings for the real estate sector. If you notice, predominantly more specialized REITs than residential or commercial. I completely got rid of my commercial real estate just because I believe the brick and mortar stores will be dying in the next 10 years. And I mean, you could just see this because Amazon's soaking up their share. Communication, the 2 holdings I have is AT&T and Disney. Disney's streaming service is on fire. I think they have over like 70 million people who signed up for it. So people are not expecting that to go up like that, but I did. And like I said, in the communication sector, if you own streaming, you win. Disney's up there. If Netflix paid a dividend, it would be up there, but Netflix is winning. And guess what? AT&T with HBO Max, it is on its way up. Like, people are sleeping on AT&T. It's a rising star. It's one of those, legacy companies that is actually going to be in a growth phase. So that's why I'm choosing AT&T over Verizon, because Verizon doesn't have a streaming service. In the financials, I did take out Visa, just like I said, and I put it into information technology where it belongs. So Brookfield Asset Management, it's an alternative asset manager. JP Morgan, Bank of America, obviously we know what those are. And the Main Street Capital is a business development company. They loan out money to these businesses. Healthcare hasn't changed because, again, I'm not too familiar with any of these, but I know Pfizer is trying to push out their vaccine. Information technology. Oh, this looks so pretty. Look at it. Visa's in the right spot, not in financials. I did get rid of Intel and IBM. Those plays were just going to take too long. And to be honest, it's better to invest in winners than companies than doing sometimes a contrarian pick and like guessing, thinking that something's going to come to fruition when really it's not. Qualcomm, great company. Apple just has a war chest of money to do whatever they want. Visa is a great company. Microsoft's a great company. I'm just picking companies that are just doing solid business. Like IBM and Intel, like they've been. Intel, I do still think they're going to come back. I don't know about IBM. Big Blue, it's going to take some time, and they're going to be spinning off their second business. And like, are they going to be paying that dividend anymore? There's just too much uncertainty for me to stay in IBM. Let's talk about the industrial pie. I did make a change. I did take out Old Dominion Freight Lines, and my thought process behind it is I already own UPS and FedEx, which are hauling freight. I didn't need to have a third freight hauler with Old Dominion, which, yes, their business is a very niche business, about like less than a truckload. I really were just okay with keeping with FedEx and UPS. I did want to have like a kind of like a conglomerate in here, and Honeywell, I think, is a good one. So it should be moving in here pretty quickly. So these shares will sell, and I'm sure it's going to purchase these. And then Waste Management, obviously, good company that's going to require, we're still going to have trash. Forgot to mention, overall, I used to have 20% in here in this real estate sector, but I realized that what I want to do is I want to switch it to 10% and switch the top secret experimental, which is the QILD, which sells covered calls, which is exactly the strategy I'm going to implement with that 16K. I want to put a little bit more money, because what I was thinking is that with the dividend income that this pays out every month, it could purchase these shares more so. Because ideally, like when 2021 hits January 1st, I want to start loading money into here as fast as possible. And once that money is loaded, like I can't put any more in, but the dividend income. So whatever dividend income I get paid out here, that could be used to be reinvested here. So I was hoping with this income coming in that ideally could buy some of these dividend growth companies. A lot of these dividends that I own don't pay too high dividends, and that's why adding this income play here can kind of bridge the gap and allow me to buy some of these other dividend growth plays. Nothing changed in this one. And then finally, utilities, Brookfield Renewable, NextEra Energy. Brookfield Renewable just bought $800 or $900 million worth of solar from Exelon, and that is a huge play. I'm actually a customer of Exelon, or it's called ComEd in Illinois, but they bought a huge portion of this renewable energy, and honestly, Brookfield Renewable is just buying up these really high quality renewable energy assets. So whoever doesn't have this in their portfolio should really think twice about having it. Again, I'm not a financial advisor, so take my recommendations with a grain of salt, but this is definitely something you want to own. So this is my entire portfolio. Let's head over to the actual dividend income. So in the month of November, I got paid $26.30 in dividend income, which puts us around right over here. Again, you know, with only having $12,000, I'm not expecting big money, you know, but what I do want to see is I want to see this dividend yield grow. Obviously, remember when I showed you in this page right over here, my yield is supposed to be like, my total yield is supposed to be like 3.94%. Well, oops, where did I go for that? Oops, I was supposed to go to this one. All right. This is obviously not 3.94%. The reason why it's not like this, because I've just been switching over the actual percentages, like 10% in the income or 20% and then 10% real estate. So I've just been switching stuff around so much that like it didn't really have time to actualize in the correct section. You know, I do have $308 paid out in like the total dividend amount. So we'll see what December brings us, but hopefully December, if it looks correctly, like, you know, some of these are trailing down. So you have quarter 1, quarter 2, quarter 3, and ideally quarter 4 will hopefully either sit around here or maybe it'll be up here. But, you know, I'm not too concerned with the actual value it's being paid out. What I am concerned about is over time, this thing growing. So remember, like if it's, what is this? September was the highest payout. So if September is $77, this in 2020, well, in 2021, it better be higher. So, you know, just want to show you guys that the dividend income is uptrending. So if I drew a line, you know, it would be in a positive direction. So, you know, this is one of these strategies I am implementing. So yeah, so these are just kind of different things that's going on. So, you know, if you guys have any questions, just please hit me with them. I love answering questions about this stuff. And, you know, if you guys have any ideas or suggestions on what I need to do, you can also let me know too. I do take criticism very well. So guys, thanks for watching the video. I really appreciate it. And I hope you guys have a great day.